Welcome to Talk Tickers. We're here to give you the quick take on today's important earnings calls.
And today, it's Invesco. We're digging into their first quarter numbers.
Exactly. We'll hit the highlights, break down what matters, so you've got the essential info you need for your day. Let's jump right in.
Okay, so first quarter for Invesco, some pretty strong signals. They reported long-term net inflows of $17.6 billion.
Okay, $17.6 billion, and that sounds significant.
It is. That's about a 5.3% annualized growth rate and adjusted operating income. That's a really nice jump, 18% year over year.
18%. And margins.
Margins expanded too, quite a bit actually, over 330 basis points compared to Q1 last year.
Nice. What about total assets, AUM?
Total AUM ended up at $1.84 trillion. Now that's nearly flat compared to the last quarter, Q4.
Okay, so inflows, but flat AUM quarter over quarter.
Yeah, market movements likely played a role there, but importantly, it's still up 11% compared to this time last year.
Got it. Year over year growth is solid then. And earnings per share.
Adjusted diluted EPS saw a big increase too, up 33% to $0.44.
Okay, so strong inflows, better profits, higher EPS, but AUM held steady from Q4. Let's dig into that income jump and margin expansion. What's the story there?
Well, it looks like a combination of revenue growth and pretty effective cost control. Net revenues climbed 5% year over year.
Driven by?
Mostly higher investment management fees.
Yeah.
They had higher average AUM compared to last year, which helps.
Makes sense.
And on the other side, adjusted operating expenses were pretty well managed, only slightly up year over year and actually down from Q4.
So earning more, spending relatively less, that's the classic recipe for higher income and better margins.
Exactly. Even with that flat sequential AUM, the assets they are managing seem to be more profitable on average, or costs are just being handled well.
Right. So where did those strong inflows, that $17.6 billion, mostly come from? Which areas are working?
The real standouts were Asia Pacific and the AIA region, that's Europe, Middle East, and Africa. Combined, they brought in $15 billion in net long-term inflows.
$15 billion just from those two. Wow.
Yeah, it's substantial. And a huge part of that was a single big win, a $10 billion mandate.
$10 billion. From who?
The People's Pension Fund in the UK. It's for customized fixed income portfolios.
Okay, that's a massive institutional win.
It really is. They funded $6 billion of it in Q1, and they mentioned another $4 billion came in April. So that momentum carried over.
That definitely highlights their institutional strength. What about ETFs? Always a big topic.
Still a strong area for them. The global ETF and index platform saw 13% annualized organic growth this quarter.
13%. Okay, solid.
Although, interestingly, they did note that overall ETF demand seemed to cool off a bit in March and April across the industry.
Right, we've heard that elsewhere too.
But even so, their QQQM ETF, that's one of their NASDAQ 100 trackers, had near record flows. Almost $4 billion came into that one product.
So specific strategies are still pulling in significant money, even if the broad tide slowed a bit.
Seems like it, yeah. Targeted demand.
And fixed income generally, beyond that UK mandate.
Also quite strong. Fundamental fixed income strategies gathered $8 billion in net long-term inflows.
What kind of fixed income?
It seems demand was particularly high for investment-grade bonds and certain municipal bond strategies, kind of the safer end of the spectrum.
A flight to quality, maybe, given market uncertainty?
That would be my read on it, yes. Investors looking for perceived safety.
Makes sense. Now, what about private markets? Everyone's talking about private markets. How did Invesco do?
It was a bit of a mixed picture. Direct real estate did well, bringing in $1.1 billion net. That was helped by another UK mandate and also inflows into their real estate debt strategy.
Okay, so real estate positive.
Yes. But private credit, on the other hand, actually saw some modest net outflows.
Oh, interesting. Any reason why?
They pointed mainly to their bank loan ETF, which saw outflows, might reflect some investor nervousness about, the economic outlook and maybe default risk there.
Okay, so some nuance within private markets, not all moving the same way.
Exactly. But they did say overall client interest in the broader private market space remains quite strong.
Gotcha. And what about their emerging market presence, like China and India?
Still contributing positively. Their China joint venture and the India business together added another $2.2 billion in net long-term inflows.
Primarily in?
Fixed income and ETFs again. Those seem to be the sweet spots there.
And they mentioned flows holding up in April, too, even with trade tensions.
Yeah. Management specifically highlighted continued positive net flows in China so far in April, which suggests some resilience despite the geopolitical noise.
Interesting. Okay, were there any major areas of weakness? Where did money flow out?
The main one was their multi-asset related capabilities. They saw about $1.1 billion in net long-term outflows there,
Any particular strategy?
primarily driven by outflows from global risk parity strategies.
Okay. And equities, how did fundamental equities fare?
That was another area with some pressure, specifically in the U.S. region, outflows there.
But not everywhere.
No, interestingly, they saw modest inflows for fundamental equity in both the EMEA and Asia Pacific regions. Management actually framed that as a potentially positive sign, maybe indicating a turn.
Okay, so regional differences matter a lot there. Now, shifting gears a bit, there was some big news on the partnership front, right? With MassMutual and Barings.
Yes, a really significant strategic announcement. They're launching a new partnership focused specifically on private markets,
Focused on what exactly?
product development and distribution, aimed squarely at the U.S. wealth management market. So think financial advisors and their clients.
And what kind of products are they starting with?
The initial focus is going to be on private, credit-oriented income solutions, things that generate yield outside of traditional public markets.
And MassMutual is backing this significantly.
Very significantly. They're committing an initial $650 million. That's for seed capital and co-investments to get these new products off the ground.
Wow, $650 million is serious commitment.
It is. And remember, this builds on Invesco's existing private markets platform, which is already about $130 billion. So this partnership is layering on top of that, really targeting that wealth channel.
Seems like a clear strategic push into a growing area.
Absolutely. Accessing private markets for individual investors is a huge theme.
And that wasn't the only big news involving MassMutual, was it? There was something about preferred stock.
That's right. Kind of a parallel transaction. Invesco reached an agreement with MassMutual to buy back a chunk of its preferred stock that MassMutual held.
How much are they buying back?
25% of it, which amounts to $1 billion.
$1 billion. How are they funding that?
They're using floating rate bank term loans.
Okay, taking on some debt to retire that preferred stock, what's the financial impact?
It's expected to be accretive to earnings per share, meaning it should boost EPS starting in the second half of this year.
Immediately accretive.
Yes, though the full run rate benefit takes longer.
Right.
They estimate a run rate EPS accretion of about $0.13 once those bank loans are fully repaid.
And when do they expect to repay them?
The target is somewhere around mid to late 2029. So it's a longer-term payback horizon for the full benefit.
But there are immediate savings too, right, on the dividends.
Exactly. They'll save about $59 million each year in preferred stock dividends they no longer have to pay.
So boosts EPS eventually, saves cash now, and gives them more balance sheet flexibility.
That's the idea. It pulls forward a reduction in that preferred stock liability, cleaning up the balance sheet structure a bit sooner than perhaps anticipated.
Okay, that makes sense. Let's touch on the financials again quickly. Any other details jump out, like unusual items or specific costs?
They did mention a $7 million non-recurring expense benefit in the first quarter, so that helped results slightly.
Okay, a one-off boost.
And they also noted the costs for implementing their big technology overall, the Alpha platform. Those were about $13 million in Q1.
Is that ongoing?
They expect it to stay in the $10-15 million range next quarter as well, so a continued investment there.
And the overall balance sheet, net debt.
Actually improved quite a bit. Their net debt position is down to $143 million.
That's quite low for a company this size. And capital return? Buybacks? Dividends?
They continued buying back shares, about $25 million worth in Q1, and plan to keep doing that. And they also increased the quarterly common stock dividend slightly from 0.2/5 to $0.21 per share.
Okay, ticking the boxes on shareholder returns. So looking forward, what was the general guidance or outlook from management?
The main message was continued discipline on expenses. Given the market volatility, they're really focused on managing costs tightly.
How much flexibility do they have there?
They mentioned that expenses typically vary about 25% with market moves, just naturally. But if they actively manage things, they think they can push that variability up to maybe 30-35%.
So they have levers to pull if markets get rougher.
Seems so. They also sounded pretty positive, as we mentioned, about the continued flows in China in April, and felt their institutional client activity remained resilient.
Okay, so if you had to wrap up the key takeaways for an investor listening to this, what stands out from this quarter?
Well, first, those strong net inflows, particularly from outside the U.S., really showed the power of their diversified global platform. They can capture growth, even if one region or asset class is slower.
Right. That diversification helps smooth things out.
Second, that MassMutual partnership. It's a clear strategic bet on expanding in private markets, specifically for wealth management clients. That's a major growth area.
A definite focus area to watch.
Third, the preferred stock repurchase. It's a significant capital allocation move that signals confidence, aims to boost future EPS, and improves balance sheet flexibility. Shows they're thinking about shareholder value.
Financial engineering, but with a clear purpose.
And finally, the ongoing strength in ETFs like QQQM and the positive trends in Asia and AIA just reinforce that having a broad product set and global reach is crucial right now.
So, resilience through diversification and targeted strategic moves.
That sums it up pretty well. Even with headwinds in areas like U.S. equities, the overall picture has some definite bright spots.
All right, excellent summary. Now let's move to our favorite segment. This is not financial advice, where we brainstorm a slightly out there trade idea based on the call. What have you got for us today?
Okay, so we've talked a lot about Invesco's big push with MassMutual into private credit for the wealth channel. That $650 million seed capital is a big deal.
Right, getting those products going.
So here's the thought. As these complex, less liquid private credit products become more accessible to, regular accredited investors through advisors, what else becomes more important?
Managing them. Reporting.
Valuation. How do you accurately price these things that don't trade on an exchange every day, especially when they're in retail-focused funds that might need daily or monthly NAVs?
Yeah, that gets complicated fast.
Exactly. So the idea is maybe look into companies that specialize in providing third-party valuation services for exactly these kinds of illiquid alternative investments, particularly private credit.
The picks and shovels play on the private credit gold rush.
Kind of, yeah. As firms like Invesco, Barings, and all their competitors roll out more private credit funds for the wealth market, the demand for independent, reliable, and maybe even technology-driven valuation solutions could absolutely surge.
Because the regulators will demand it, and investors will too.
Precisely. You need transparency and consistency. So investing in a specialized valuation provider could be a way to play the overall trend of private credit expansion into wealth management without betting on Invesco's specific new funds succeeding.
Interesting angle, focused on the supporting infrastructure needed for this shift.
Exactly. But remember, folks, this is purely hypothetical brainstorming, definitely not financial advice. Do your own research, please.
Absolutely. A thought-provoking idea nonetheless. Well, that brings us to the end of our deep dive on Invesco's Q1 call.
Yeah, a lot going on there. Strong inflows, margin expansion, and some really key strategic moves, especially that MassMutual partnership and the preferred stock buyback.
We hope breaking it down like this gave you the clarity you need. As always, remember, this is just our take. Do your own homework before making any decisions.
What did you think? Does the private markets push excite you? How about that stock repurchase? We'd love to hear your perspective.
Join the conversation. Let us know what stood out to you.
And be sure to join us next time for another earnings call breakdown, right here on Talk Tickers.